Welcome to The Explainer. Look, if you've been in the market for a bit, chances are you've got mutual funds doing the heavy lifting in your portfolio. We all love them for the diversification, right? But today, we're looking past those standard benefits to uncover a serious math-backed warning about your long-term wealth. We're talking about a silent cost that might be quietly siphoning away your returns without you even noticing.
So here is our roadmap for today. We'll hit 1, the mutual fund solution. 2, how mutual funds work. 3, the expense ratio trap. 4, a tale of two funds. And 5, types of mutual funds.
Starting right off with Section 1, the mutual fund solution, overcoming the stock picking problem.
You know the absolute headache of individual stock picking? Doing it right requires intense, fundamental analysis, constantly refreshing earnings reports, and honestly, an iron stomach for risk. Well, a mutual fund solves this simply through scale. By pulling capital from thousands of folks just like us, it acts like a massive financial syndicate. You aren't just buying a simple basket, you're buying fractional ownership of a professionally managed, highly diversified portfolio. Replicating that on your own would cost an absolute fortune in trading fees. It basically takes the capital power of giant institutions and hands it directly to you, the everyday investor.
Moving right along to Section 2, how mutual funds work, the mechanics.
Let's quickly break down the actual daily mechanics here. First off, you purchase shares of the fund itself, rather than buying the underlying companies directly. Second, the professional manager takes all that pooled money and buys a portfolio of securities based on their specific strategy. And third, the fund calculates its net asset value, or NAE. Now, this is a really critical distinction to understand. Unlike a stock or an ETF that is bouncing around wildly minute by minute based on live bid-ask spreads, a mutual fund's NAV is calculated just once, right at the close of the market. That end-of-day valuation actively strips out all that intraday market noise. It just takes the total value of the fund's holdings, subtracts liabilities, and divides by the outstanding shares. Easy.
And the real structural magic here? Instant diversification. Instead of your portfolio taking a catastrophic 20% nosedive because one tech CEO made a terrible late-night tweet, that risk is heavily diluted across dozens, maybe hundreds of different assets. You are shielded from those weird black swan events that can wipe out a single company. Combine that safety net with experienced professional oversight and incredibly low minimum investment thresholds, and it makes total sense why this became the foundational bedrock of practically every modern retirement account out there.
Which brings us to Section 3, the expense ratio trap, the hidden complication.
So, by definition, an expense ratio is the annual fee a fund charges expressed as a percentage of your total investment. Let's put some context around this. For actively managed funds, where you've got teams of analysts constantly buying and selling to try and beat the market, this fee typically sits between 0.5% and 1.5%. They're charging you a premium for their supposed genius. On the surface, a 1% fee sounds literally like a rounding error, right? Just a tiny fraction of a percent. But as we're about to see, the mathematics of finance are absolutely ruthless.
Here is the absolute most dangerous part of the expense ratio. It is entirely invisible. You literally never write a check for it. Think about it for a second. If you had to wire 1.5% of your total net worth to a guy in a suit every single December, you would scrutinize that cost aggressively. You'd demand to see exactly what value he provided. But because this fee is automatically deducted directly from your returns behind the scenes, there is zero psychological friction. It entirely bypasses our normal financial defenses and silently subtracts from your wealth year after year, completely in the background.
Let's look at Section 4, a tale of two funds, the cost over 30 years. Let's put some hard data to this concept to really show you what I mean. Imagine a $10,000 initial investment, left completely alone to grow for 30 years. We'll assume the broader market returns 7% annually before any fees hit. Setting up the rules of our game, we have two options. Fund A is actively managed, taking a 1.0% expense ratio, dropping your net return to exactly 6%. Fund B is a passive, low-cost index fund with just a 0.1% fee, netting you a 6.9% return. So we are looking at a seemingly microscopic 0.9% difference in fees for the exact same underlying market performance.
Okay, fast forward 30 years. We all know compound interest is called the eighth wonder of the world, but the danger is that it works in reverse too. It compounds your costs just as aggressively as your returns. Over 3 decades, the actively managed Fund A grows to $57,430. Not bad at all. But Fund B, with just a fraction of a percent lower in fees, that low-cost basket skyrockets to $74,020.
Yeah,
That microscopic 0.9% difference costs you exactly $16,590 on a starting baseline of just 10 grand. You surrendered over 1.5 times your original investment directly to the fund manager. That is not just some spreadsheet anomaly. That's a car. That's a house down payment. That is literal years added to your retirement timeline, just silently vanished into the expense ratio trap.
The huge takeaway here is that high expense ratios are basically the termites of the investing world. They silently eat away at the foundation of your wealth. And remember, because this fee is levied on your total assets under management, not just your profit, it compounds aggressively against you whether the market is up or down. Before you ever click buy on a mutual fund, you absolutely must locate that expense ratio. It is the single most controllable variable in your long-term financial security.
Finally, Section 5. Types of mutual funds, navigating your options.
Look, the market gives you an endless menu to structure your portfolio to perfectly match your exact risk tolerance. You've got your standard stock and bond funds, you've got balanced funds that automatically manage asset allocations for you. But keep in mind how this connects back to our termite problem. The more specialized you get, like diving into niche sector funds for AI or international funds dealing with complex foreign equities, the higher the active management costs tend to be. Specialized research costs money, which usually means a substantially higher expense ratio gets passed right on to you.
Every mutual fund offers a path to wealth, for sure, but they all carry a toll booth. As you review your own portfolio today, I want to leave you with a provocative question to ask yourself. Are the fees you're paying silently funding your own early retirement, or are they quietly funding your fund manager's next luxury vacation? Seriously, log into your brokerage today, locate your expense ratios, and find out exactly what you're paying. Thanks for joining me for this explainer, and keep learning.